Hey everyone, this is Matt with the Fundamental Investing Institute. Thank you for tuning in. And we are finally reaching what was my goal with this little video series, and that is the beginning of the modern Federal Reserve, what some economists and historians have called the second founding of the Federal Reserve. And this comes about with the banking reforms in the 1930s. Of course, there are many banking reforms that occurred in this period as part of the overwhelming period of reform that's kind of known as the New Deal. But I want to focus on two that really bring about the modern structure of the Fed. And our goal with this video series was to get to a point where we can kind of talk about the United States getting to a national uniform monetary policy. Because before this, the Federal Reserve, these are 12 banks that are operating kind of semi-autonomously, different periods of cohesion, but for the most part, there was no real unified structure. And also the Fed, the individual reserve banks were mostly privately owned, and this led to some real problems. In fact, there are a lot of people who continue to talk about the Federal Reserve as a privately owned entity. That's really not accurate in terms of how decisions are made, policy is set. But let's start with the Banking Act of 1933. This is known as the Glass-Steagall Act, and I think anyone who has studied money and banking is going to be familiar with this. And I think most people are going to be familiar with this because it really does two things, two major things. Number one is it establishes a Federal Deposit Insurance Corporation, or the FDIC. And this is important because by providing a federal guarantee to bank deposits, at least up to a certain limit, it effectively ends the kind of bank runs that we saw in the early 1930s. So bank runs really haven't been any major feature of the banking system since then. And then the second thing is it separates commercial banking and investment banking. Now we know what commercial banking is. This is just taking deposits and lending money. But investment banking, which is securities underwriting and mergers and acquisitions, corporate advisory, this gets separated out. So the same institution cannot be involved in these two endeavors. Now that's since changed. That changed in the late 90s, early 2000s. But the Banking Act prohibits this, and it leads to an evolution of a banking system that's very different in the United States than it was in the rest of the world. And the Banking Act of 1933, or the Glass-Steagall Act, this is a big reason for that. Now, there's two lesser known provisions of the Banking Act that are very important for the history of monetary policy. One is it creates the Federal Open Market Committee. And this is the committee that really sets monetary policy. Now, the 33 provision wasn't really its modern incarnation, but it does get established in that act. And then the second thing is Regulation Q, and this becomes important later, but Regulation Q, one is a prohibited interest paid on checking accounts. And the second thing is it gave the Federal Reserve the authority to establish ceilings on the interest that banks could pay on deposit accounts. That became very important in the inflationary 1970s. But the major act that establishes the modern Fed is the 1935 Banking Act. This is enacted in April of that year, and Title II of that act establishes the modern structure of the Federal Reserve. So the modern structure of the Fed is that we have a Board of Governors in Washington, Board of Governors of the Federal Reserve System. These are 7 members appointed by the President and confirmed by the Senate. So they are essentially political appointees. And remember that before the Federal Board of Governors, the Treasury Secretary and the Comptroller of the Currency sat on the board of the Fed. With this act, they're removed. So this really establishes the independence of the Fed. The other thing is they were still operating out of the Treasury building. And this gave them, it actually led to the building of what is now the modern Federal Reserve building called the Eccles building. So they move out of the Treasury. So this is very important in kind of establishing the Federal Reserve as a distinct entity that we know now. And in short, the Banking Act restructures the Fed, as I said earlier, to create a national monetary policy. Now, we're going to provide, at the Fundamental Investing Institute, we're going to provide a lot of content and talking about how the Fed operates, but I wanted to create this video series to kind of talk about how we get to this modern structure, because it's a misunderstood institution, and it's very important for investors to understand how the Fed sets monetary policy. We'll continue to talk about these things. We'll put out a lot of content as to how the Fed works, as to how credit markets work. But I just kind of wanted to talk about, when the Fed was founded in 1913, and then kind of talk about how it evolves. It certainly evolves after the 1935 Banking Act in many ways, but the 35 Banking Act, this is what establishes the modern structure of the Fed, and this is what gives the country this national monetary policy. That did not exist before. It's a very important event in monetary history. Thank you, everyone, for tuning in. I appreciate you guys watching this, and continue to tune into our channel as we produce more content on this and other subjects.